Hello everyone, and thank you for listening to our Burkenroad Report presentation. My name is Andrew Albano, and I'll provide an in-depth analysis of Gulf Island fabrication on behalf of my equity research team, Chris Valentini, Tolu Adiogba, Jacqueline Lee, and Wendy Zhu. Today we will first introduce the company and then provide a peer analysis. After that, we will go over the investment summary and valuation of the company, and finally offer our investment recommendation. Gulf Island Fabrication is a leading fabricator of offshore drilling and production platforms used in the production and development of offshore oil and gas reserves. The company was founded in 1985 by Alden Laborde, Huey J. Wilson, and other investors. The company started to expand its scale of business through mergers and acquisitions, backed by the strong energy market of the 1990s. On February 14, 1997, Gulf Island went public, listing on the NASDAQ under the ticker GIFI. Gulf Island earns business from customers through bidding on projects. The company and its subsidiaries are located in two strategic locations, Houma, Louisiana, and Aransas Pass, Texas. Gulf Island predominantly operates its business in two main sectors, product fabrication and construction services. In the domestic market, Gulf Island generated approximately 66% of its revenue over the past 5 years from sales of fabrication and related services in the Gulf of Mexico. The major customers were E&P companies. As shown in the figure, 2 to 3 customers contributed a large portion of Gulf Island's revenue for the last 3 years. Also, the biggest consumer varies in different fiscal years because of the project-oriented nature of the company's business. The company primarily manufactures specialized sections for fixed and floating production platforms. In addition, the company also produces pressure vessels, large and small package skid units, conventional jackets for deepwater drilling facilities, wellhead protectors, piles, subsea templates, and various production compressor and utility modules. The services provided by Gulf Island include onshore and offshore scaffolding and piping installation, heavy lifts for ship, TLP, semi-submersible module integration, loading and offloading drilling rigs, and maintenance and repairs of third-party marine vessels. The barriers to entry for offshore fabrication in the Gulf of Mexico have led to relatively few direct competitors for Gulf Island. Oceaneering, McDermott, and Caldive are Gulf Island's closest peers in the oil and gas fabrication and services industry. These companies share similar costs and revenue drivers, such as deepwater fabrication projects. McDermott competes with Gulf Island directly for fabrication contracts, whereas Caldive and Oceaneering focus on providing supplemental services. This table uses basic financial metrics to compare the performance of Gulf Island to its closest peers. Relative to Oceaneering and McDermott, Gulf Island is a small company with a market capitalization of $439.31 million. Despite the company's smaller size, it has a competitive advantage over some of its peers. For example, its debt-to-equity ratio of 0 indicates a strong balance sheet and greater ability to compete with larger companies. Gulf Island's dividend payout suffered during the financial crisis, but it began increasing back to pre-recession levels in 2010, suggesting the company is recovering. We give Gulf Island Fabrication a market outperform rating and project a 12-month target price of $37. We project an increase in revenue because of the increase in Gulf Island's trending backlog. The number of man-hours worked as of December 31, 2011 was 4.6 million, compared to 3.8 million December 31st of 2010. With Gulf Island expecting to be awarded new deepwater projects later in 2012 and during 2013, we expect this trend to continue. Another bullish sign for Gulf Island is the expectation of increased capital expenditure by E&P companies in 2012. As the global economy continues to expand, E&P companies will continue to try to keep up with demands. If the supply from strategic reserves is not deployed, according to Burkenroad's forecast, we expect oil prices to average above $102 per barrel throughout 2012. The company also raised concerns about retaining a sufficient workforce to handle all of their backlog in the short term. Gulf Island's current stock price is $27.95. We project a target price of $37. We arrived at our target price using the weighted average of 3 valuation models: the discounted cash flow model, relative multiples including price to earnings, price to book value, and price to cash flow per share, and dividend discount models. Under the DCF method, using a weighted average cost of capital of 17.24%, we discounted the free cash flows over a 10-year forecasted period to arrive at an estimated stock price of $41.52. The dividend discount model works well for Gulf Island because the company paid out dividends constantly during the last 5 years, which makes future dividends predictable. We discounted future dividends back at a rate of 13%. As a result, we reached a forecasted price of $29.26. The relative multiple method measures the target price by the 5-year average historical multiples from 2006 to 2011. We excluded 2008 as an outlier. We put the largest weight on the relative multiple method because this method gives credit to all financial aspects we estimated and also incorporates the historical performance. In determining Gulf Island's 12-month target price, we considered a few fundamental aspects of the company's operations and financials. First, Gulf Island's high backlog will allow the company to operate at full or near full capacity in 2012. Delays in quarter 4 of 2011, combined with new projects available for bid in 2012, will make 2012 a strong year for Gulf Island. Additionally, Gulf Island expects to bid on 2 new projects in the second half of 2012 and potentially 3 new projects in the first half of 2013. Second, we expect increasing oil prices and a recovering economy to increase demand for Gulf Island's products. The EIA expects the price of WTI crude oil to average about $100 per barrel in 2012 and continue to rise moving into 2013. Because the U.S. economy is expected to continue to grow in 2012, we believe oil consumption will continue to outpace production. And lastly, in Louisiana and to some extent in Texas, unemployment levels in the company's areas of operation are relatively low. As the economy improves, it may become difficult for Gulf Island to attract and retain skilled workers in the coming years. In conclusion, our 12-month target price is $37, and we recommend a market outperform rating for Gulf Island. That concludes our presentation. On behalf of our analyst team, we would like to thank you for listening to our presentation, and we hope you enjoyed it.